Hello and welcome to the 2-minute warning interview series where we ask what is next in the energy transition and most importantly what should be next. This is a huge complex question that we're going to aim to shed a little bit of light on in the next 15 minutes. The climate clock is ticking louder than ever, something we're all increasingly aware of and certainly should be aware of, and we as a people are significantly lagging on our 2050 goal, and we're still waiting to see how a wave of net zero commitments in the last 12 months are going to be realized. So to help me shine a little bit of light on this conversation, we've got Stacey Swan with us today. She is the CEO at Climate Finance Advisors. She's based in Washington, DC, so it's an early start over there. Stacey, hi, thank you very much for joining us.
Good morning, Michelle. Nice to be here. Thanks for having me.
Thank you, thank you. Let's get started. We've got 15 minutes or so we'll just dive right in on the money side, that money makes the world go round, as the argument goes. At the moment, we still see this big gap, a mammoth gap, arguably, between the need for investment in climate change adaptation approaches on one side, and then the reality of current financings on the other. So estimates from the UN put the need at about $300 billion per year, yet international finance flows for this are only about $30 billion per year. Do you see that gap closing as fast as it needs to?
It's definitely not closing as fast as it needs to, but it's starting, and the signals that we're starting to see make me hopeful that at least in the next couple of years, maybe even a shorter time frame, we'll start to see some, significant awakening and potentially kind of adjustments in how kind of the financial sector deals with both climate risk and the opportunity side, so that net zero side. And from that perspective, I think, a few things have come together in the last 5, 6, 7 years that has really kind of driven home the awareness in the financial sector. The first is where 20 years ago, 10 years ago, 15 years ago, the discussion around accelerating investments to address climate change was really an energy discussion and an energy transition discussion. I think since 2015, both in terms of kind of the obvious and visible effects of the locked-in warming, physical impacts of climate change, and the losses that they result in, I think that's starting to kind of really raise people's attention in the financial sector that there's actually risks here to deal with. And once you kind of have that awareness, once you understand that actually kind of this is not a long-term kind of far out thing, then that opens up let's say a less politicized discussion around the net zero transition. That's accelerating quickly, partly because of the sad fact that we've locked in enough warming that these impacts are starting to be visible and obvious, but also the regulatory landscape that's changing around climate-related financial disclosures. That has a way of driving home for investors and corporates that there may need to be some assessment and identification and management of risks that they really thought were kind of things they could potentially do kind of in the future. Yeah, exactly.
And you mentioned there about the financial awareness growing since 2015, but also the consumers' awareness and the public awareness of all of this. I've been covering this for around 15 years, and it's only in the last 6 to 7 months that friends of mine have started saying, we're not eating meat Monday to Friday because we want to support biodiversity, or we're investing in solar panels because we've been watching these documentaries XYZ, and we're more aware of the Paris Agreement and what this actually means, and so on. So the filtering through from what historically used to be a very niche group, and some even then in the energy sector were very reluctant, and it's pushed through that, and now they've become some of the biggest innovators in this space. That filtering certainly seems to have accelerated. How central do you think the growth of ESG, which we've seen a huge surge in the last year, is to this overall conversation with the financial world? Because a lot of major companies are now tying executive pay to sustainability. I think as of March this year, it's nearly 50% of FTSE 100 companies have linked executive pay to ESG targets. I mean, that's huge.
Yeah, I think this is really significant, and I think it's a huge start. So first, I would agree with you. I think general population awareness of climate change is kind of on the rise and accelerating. This is not, incremental. This is really scaled up, and perhaps it's because of COVID. Perhaps it's because people are starting to understand that climate isn't a problem to be solved; it's a problem to be managed and solved. But that we have locked in enough warming that we'll have impacts to deal with regardless of whether we stop all emissions today. That's just the fact. And I think it doesn't, it's not kind of deep science to understand that particular fact. I think on the ESG, the movements around ESG, from my perspective, that's fantastic, because that's the first step to understanding that you've got to get your hands around climate and around how to manage those risks. I always caution people that ESG, as it's been historically kind of formulated, is really, or has historically focused on what the asset or the investor or the entity does to the environment. And if you're thinking about climate from a lens of ESG and your tools to understand ESG are not comprehensive enough to integrate what the climate does to your asset, then you're missing really significant kind of area of both understanding your risks, but also opportunity side. And a number of entities use ESG tools, which are just starting to kind of become kind of more comprehensive on that climate risk side. So it has to be ESG and climate risk. If your ESG approach incorporates what the climate or the environment does to your asset in terms of riskiness, then that's great, because that gives you the ability to take that information and use it for forward strategy, investment planning, risk management, right? Making sure you're not having value at risk that you haven't figured out how to manage.
I was actually going to ask you about technology in terms of innovation, where there should be a focus on technology, but I think perhaps you've answered it in that question without realizing. Would it be data? You were saying about, with ESG and being able to actually monitor what progress is being made so that you can effectively mitigate it or strengthen it, weaken it, whatever the numbers give you guidance to do. Would you say that better data management in terms of accruing it and storing it and then harvesting the intel from it, and perhaps also open platforms for data, do you think that that's a big neon flashing missing gap in this whole finance conversation that people are aware enough about?
Yeah, so yes, and so one of the most exciting things to happen in the climate space in the last 5 years has been the rise of climate-related analytics, climate-related risk analytics and data platforms. Some of the more important things to understand about those data platforms, and this is true whether the data is open sourced or whether it's kind of a tool that you're procuring or a software service that you're integrating into your risk management. Your use case matters, particularly for physical risk. So what does that mean? Your pension fund, your institutional investor, your infrastructure bank, your private equity, all of those different types of financial actors have different thresholds they invest around. They have different time horizons that they invest in. They're not, some of them are shorter term than others in terms of how they invest in projects. And what you need is the functionality in that data analytics to be able to both identify, assess, and quantify the climate-related value at risk to your assets, both the pipeline and the portfolio, but not just on a long time horizon, but matched up to where your use case is needed, because that's going to help you inform the rest of your decisions. That analysis helps you do the portfolio management. It helps you do the strategic planning. It helps you find new markets. All of that's really important. That's the first thing. The second thing is people tend to forget when they think about climate risk data and analytics, and let's say under the guise of TCFD, they tend to forget that this is kind of an ongoing process. You can't just do a risk snapshot in time and say you've done your risk analysis, because risk today is different than risk tomorrow, is different than risk next quarter or next year. So the functionality that you might integrate into your organization or your financial institution needs to be tracking kind of as you track your risk and as you use that information to make your investment decisions, your portfolio allocations, that kind of thing.
Because we're still seeing it quite a lot of conversation. The awareness is certainly rising undeniably, but we're also seeing quite a few conversations where people will talk about the fourth industrial revolution and the digital tools as part of that, and then they'll talk about climate mitigation. and they don't tend to join those two worlds. There's a lot of people still seem to see them as two separate camps. Is that something you're seeing as well?
I think it's starting to join together, but it certainly is. It certainly is. I would agree with you. It's certainly still kind of, people think of these things as two separate kind of things to be managed. But you know, some industries, some corporations, particularly ones with high energy costs or high energy usage or water exposure, either in terms of usage or vulnerability, I think they're kind of starting to see the mitigation side connecting up with the adaptation / resilience side more clearly. And so that's pretty important. But to your point, I think the one other thing that I think is useful to know about the data and analytics tools is that you have to have people inside your organization who understand what to do with the information. And it's one thing to have the snapshot and then maybe issue a report or maybe issue a disclosure or a CSR report and say, okay, we've done this analysis and this is what our risk looks like over a long time horizon. But you need to have the people inside the organization understand what that means contextually. And that's, I think, where there's potentially, you know, the next wave of awareness that's kind of coming together. A lot of people have looked at tools. Some people are using tools. Some people are building tools. Some people are figuring, well, I don't want to invest in a tool. I want to use open source data. And then they realize it's very difficult to translate it for their use case. But in any case, all of those circumstances require the people, the skills, the capacity in the organizations to be able to translate that, whether that's credit and risk people, whether that's investment people, whether that's management, all of the above. That's where you need to start kind of seeing, you know, potentially a little bit of shifts.
And that takes time. Curating that sort of talent takes time. Do you see that as being one of the big risks of this decade in getting enough talent in place in order to, yeah, you do?
Yeah, I think it's happening though. I mean, we're seeing you know, waves of young people. Back to one of your earlier comments, there's significant numbers of young people who are interested in helping and working on the climate issue in various ways, and this is a huge gap in terms of, you know, the numbers of people who can help. I also think that you have a good number of experts and advisors and organizations who are, you know, who are hiring people who can help do that translation on a strategic basis. And I think it's not, you know, it doesn't take that long to start connecting the dots from a management perspective or a strategy perspective. So you could kind of build that awareness relatively quickly, right? I mean, you have to understand how climate will how it will impact your organization and what that means for your organization. But once those pennies start to drop, for management and for the board and for others, I think it's relatively quickly that they will start to say, oh, okay, well, this is something we need to kind of really start to integrate into how we do our operations, how we plan our operations. I like to say
part of the norm for them.
Well, yeah, and I like to say, you know, you kind of put it into the DNA of the organization, and that has its own cascading effect, and then you can really kind of build up that knowledge and awareness. It's not, in my view, I think kind of 20 years ago, we all thought climate was part of ESG, and that team sat at the end of a long dark hall in the organization and got rolled out once a year to do the CSR report or whatever. I'm joking a little bit, but I think
partly.
You know, certainly it's for my friends who did that, it certainly felt that way by them sometimes, but I think that people, and certainly management that's starting to connect these dots, are starting to realize that this is across the organization, and it's something that you need skills and capacity and people who are kind of aware and mindful of this stuff in every role and every function. So it becomes a little bit more mainstreamed or in the DNA of an organization.
I like the DNA and the cascading effect. I think that encapsulated it perfectly. We're going to wrap up shortly, but I just have one last question before we do. We've got what, 9 or so months left to the year, 8 or so months left to the year. What would you hope to see, or what is your focus in the work that you do for the rest of this year? There's so much going on. There are so many pressure points and priorities. It's a very noisy space. What do you think should be zoomed in on and the priority?
Yeah, for sure the people, for sure the capacity, for sure the skills. In every conversation that we have, whether it's around strategy, around risk management or investment, it's clear that we need, many, many millions of people who are working on this. Some people like to say armies of people who are kind of addressing this issue with all kinds of skill sets and all kinds of capacities and all kinds of roles. So that's kind of a headline kind of wish. I really think that we're accelerating awareness, and now it's about time to accelerate action. And in the finance part of it, I think you've got some real momentum, both in terms of the awareness and in terms of the policy and regulatory changes that have happened in Europe and might be on the horizon in other places. But actually, there's another kind of driver, which I think is potentially going to be more forceful, which is that you're already starting to see climate risk show up in cost of capital for some asset classes. And once that penny starts to drop as well, this becomes less of I'm being pushed to make commitments because I'm being pushed to make commitments by the outside world or the board or whatever. And actually, this becomes a real strategic business problem. If your cost of capital, yeah, and there is also some emerging research, which I'm delighted to see out of some universities in Europe and the IMF, which is also starting to hint that if an entity has a plan to address climate risk and build in resilience, that cost of capital kind of hit goes down, meaning you actually get some benefit from actually having a tangible strategy to address this. And that's everybody. That's governments, that's sub-sovereigns, that's corporates, that's the financial sector. I think there's—
And in a post-COVID world, that's highly, highly attractive. It'd be attractive anyway, but in a post-COVID world, it's another level, really.
Exactly, and it's not headlines, right? I mean, if the rating agencies are the entities where you're starting to see this show up, right? They've all internalized the capacity to do climate risk assessments. So all of them have the teams or the skills, they've acquired them or built them or both. But that to me says this is not about headlines anymore. This is not about ESG reports or CSR reports anymore. They're going to be looking for real, tangible, serious strategies to manage climate risk and to become resilient. And I think you're going to start to see some kind of differentiation around that, potentially in the cost of capital, depending on how you manage your capital. The data that I was referring to a couple of minutes ago is really around sovereign bonds, but this can translate into a number of asset classes. That is a driver too. So we have all these drivers that are coming together over the last 5 years. And I think real serious organizations are going to start to think of this as a strategic competitive advantage to be. As
it moves more and more away from the sentiment and the emotional argument for it will move more and more into the hard cash, essentially. Which we're already seeing already, but a surge in that is certainly what's needed for the magnitude of the challenge. Stacey, thank you so much for joining us. I feel we've only just gotten to the tip of the iceberg, but perhaps you'll be able to join us again and we can dig a little deeper. Thank you very, very much.
Yeah, my pleasure, Michelle. Thanks so much.
Thank you.